After you've come up with a scoring system for the stocks that you're considering, there are a few different ways you can use these so-called alphas scores. Option A, the simplest approach, is to pick the top stocks based on their alpha scores and invest in them equally. In our example, that might mean 50% in Apple and 50% in Meta, since they both scored the highest alpha of 4.5. Option B, which is a bit smarter, uses the scores as portfolio weight. For instance, Apple and Meta might get 28%, Nvidia 22%, and so on, all based on their alpha scores relative to each other. This approach also gives you more diversification because you're spreading your investment across more names. Option C, which is more advanced, combines the alpha scores with each stock's volatility and the correlations between every pair. This lets you build a portfolio that balances expected return with risk, and that's what hedge funds do. This process is called mean variance optimization. It doesn't just look at which stocks have the highest expected returns, it finds the best mix. Your optimal portfolio depends not only on return expectations, but also on each stock's volatility, their correlations, and how much risk you're willing to take. This trade-off is captured by something called the utility function. And why do correlations matter? Because when stocks don't move in sync, you get diversification, the magic word in investing. You can use the solver add-in in Excel or free tools like Portfolio Visualizer to run this kind of optimization yourself and target what's known as the efficient frontier. For a detailed breakdown, watch the full video on my channel.